Let me share the desktop. Yeah. How's it going, guys? All right. So to begin, we're just going to talk about the weekly range review. As we know, this week was NFP. Normally, the first Friday of every month is going to be NFP, non-farm payroll. And you also most likely are going to get the unemployment numbers coming out as well. After that, we're going to talk about the IPDA data range. We're going to talk about the smash day candles, and we're going to talk about high probability scalping. If you guys can't hear me or other people can't get the link, just be aware of that and just let me know. If people do need the link, I'll reshare it again for them. So to begin, some of the concepts that I like to use in general when trading throughout a week is SOP, which is Sunday's opening price. And we can see as well Sunday's opening price is also the opening price for the month here. And we're looking at gold here as well on the 1 hour time frame. We got broken down from Sunday to Friday. And we can see it's just carnage back and forth. Nothing really going on until around NFP, the well-anticipated news event coming out here. So you got NFP and unemployment here. That's really what the market was waiting for most currency pairs. I normally suggest traders not to trade this week. It's just not ideal unless you're able to find small opportunities, 10, 15, 20 pips. Do not look for any home runs. Normally, NFP is going to bring everybody to the table and flush them out, or the week in general will be seeking the short. It's going to take out the previous daily high, or it's going to fail to take out the high, or it's going to fail to take out the low, or it's going to take out the low. So this week normally would be a washout. Don't trade. Normally trade the second week of the month. The first week, just let everybody come in, trade, because that's where most of the retail traders are going to be put on the wrong side. We'll talk about that a little later when I'm talking about high probability scalping in the IPDA data range. But you can see this whole week just back and forth. So if you look at GU, we've got more excitement here. And once again, we have Sunday's opening price. And looking at this chart, we could see that Wednesday makes the low of the week. It's very obvious, it's hindsight, but we can see Wednesday makes the low of the week. Generally speaking, in bullish conditions on any bullish week, Monday, Tuesday, or Wednesday might give you a buying scenario, especially if you're below Sunday's opening price. That can include trading during Asian, London, or New York. Those are the only time frames you should be concerned with when trading intraday. Anything else besides that, you're chasing price. That's how I like to view it. So if you're trading outside of any of the non-highlighted areas, you're most likely chasing price. If you're trading inside of these green, red, or blue highlighted areas, you're most likely going to find an opportunity to trade. It's ideal to trade in those time periods. Green is Asian, red is London, and blue is New York. So we're not confused. And I know many people want to see the indicator. So it's this one here, FXN. And then I have a video showing you how to get the presets for that as well. But anytime price drops below Sunday's opening price, it's most likely cheaper. And the way I like to think of it is, let's say you're at an auction, right? And you realize someone had lowered the price or put a pair of, let's say, sneakers, for instance, or a bag or a purse on the clearance rack, you're most likely to buy it because it's cheaper. It essentially had lost value, and you want to buy it at a cheaper price because it could potentially in the near future gain value and be expensive again, and you could probably sell it for a profit. So that's what happens on all markets. Markets are going to buy low and cheap, and then inverse markets are going to sell high and a premium when it's more expensive. We could see how it drops below Sunday's opening price and creates a low down here on Wednesday. Normally, your ideal day is to find the low of the week is going to be a Monday, Tuesday, Wednesday. I ideally like to tell people leave Monday alone, wait for Tuesday, Wednesday to trade. So if you want to keep it simple for yourself, because a lot of people, in my opinion, they don't have a model to when they should or shouldn't trade. And you should start by picking certain days to trade. And I think it's very straightforward. If you pick, let's say it's not even Monday that you want to not trade and you don't want to go and take my advice, you can trade Monday, Tuesday only. Or you could trade maybe just Wednesday, Thursday only. All depends on what you would like to, depending on your life schedule. So some people are busy, so you can't trade every single day. Some people work a 9 to 5, they're off 2 days. So that's something I would suggest. Pick a day. So like let's say Monday, Tuesday, you're off from work. These could be the days that you're looking to trade. And when are you going to trade? You're going to trade in the London or the New York session or the Asian session later that night. And the same thing would follow suit for any other days that you choose to trade on. Now, we could get more complex and we start getting into models and start getting into filters. And I'll give some tips on that as we get into the higher time frame, IPDA and directional bias and things like that. But overall, when I'm looking to buy, it needs to be in a discount. I don't want to buy in a premium. Doesn't make sense to buy at higher prices. You want to buy as cheap as possible. To you as a retail trader, it's easier to take on less risk when you buy cheap. For other players in the hierarchy, let's say the large speculators or the commercial speculators, those players can buy in a premium. They can afford to do that. For us, we're not on the higher hierarchy. We're still at the bottom of the pyramid. Excuse me. Mute that. We have to buy cheap because most people don't have the equity to buy and hold for longer prices and have a larger risk. We have small risk parameters as retail traders. Most people are risking 1 to 2%. Max, I know some people that risk 5%, but ideally, most people risk 1 to 2% per trade or per 3 trades, let's say. Take a look at UCAD. And we're currently tracking UCAD for the month of October. So if you're not in the Telegram channel, I could definitely include you and add you into that. Because I know some people aren't in the Telegram channel, but their friends share the links and they join and they're still not in the Telegram channel. You can see here for UCAD, it's a little different. You can see we went up into a premium versus GU, which is inversely correlated to the dollar. GU went up above Sunday's opening price and a premium. And if you're in the chat, I've been saying all week, I said, I'm only looking for sell setups. I'm waiting for price to drop back down. You can see it happened later in the week. Wednesday, we had a sell-off here going into Asian. And then Thursday, London made the high of the week so far and continued to sell off into Friday. This is normally the idea of what you're trying to find when you're looking for a sell above Sunday's opening price. Now, intraday, it could be a little different. There's some key elements you may want to follow intraday. For instance, let's take Thursday as example. So let's say we're breaking down Thursday and we know that we're in the premium here. Let's say the model that we chose to pick out was Thursdays, right? We only want to trade Thursdays. Looking at this, when Thursday comes around at midnight here, that's 12 a.m. New York Eastern Standard Time. When price comes here, where am I in respects to Sunday's opening price? Above in a premium. So it's much more expensive. Should I be looking to buy ideally or should I be looking to sell ideally? Most likely to sell. So I'm going to wait for some type of swing high, clean highs, or relatively equal highs to get rated during one of the kill zones. That's normally what I would look for. An easy way to break it down is you take the Asian session high and the Asian session low. So what you're doing is you're taking the Asian session high as your buy side liquidity, and you're taking the Asian session low as your sell side liquidity. Now we know that the market chases liquidity. Primary driver to the market is the interest rates. So yield, those things go hand in hand. But I'm not going to confuse too many people with that until we start getting into IPDA once again, because that's where more of a fundamental and technical analysis and macros come into play. The Asian session high is going to have buy side liquidity above it. The Asian session low is going to have sell side liquidity below it. Normally, the characteristic of this session is consolidation. So if you didn't know, each one of these kill zones have a characteristic to itself. They don't all do the same thing, but they do work together to make a full trading day. Asian is normally known to give a consolidation for most pairs. If it's a yen cross, most likely might have more volume during that time of the day. But generally, Asian session consolidation, price is most likely going to move sideways. London, most likely going to see a lot of volume come into the market, and you're going to see it take one side of the Asian session, whether that's buy side, the Asian high, or sell side, the Asian session low. If you see the Asian session high rated going into London and the low is still intact, you have possibly found a way to get short into the market without making too many hard decisions on finding a PDA, because I know that can be complex for some people. Finding, oh, which order block should I pick? Which fit? Sometimes you got to keep it simple. And I think this is a very simple approach. Intraday, you're going to place a sell stop, because I don't want to talk about the same thing other people talk about. You're going to place a sell stop here, and you're selling on weakness. Because if you're anticipating price to go short after taking out what? Clean highs. So all this is clean highs. It even ran the one over here in London close. So it ran out a previous daily high. Previous daily high. What's above this previous daily high? Buy side liquidity. What's below the previous daily low? Sell side liquidity. So let's say this is the sell side here. Previous daily low. If we had to make a target on the easiest draw on liquidity for the day, it would either be the previous daily high or previous daily low. You can see early on into the day, it runs the previous daily high on Thursday. We're above Sunday's opening price, and we know the commercials are most likely going to sell after breaking a high. Nobody sells normally after breaking a low, unless they're retail. But ideally, the commercials are going to get their best sell position when breaking a high, because you're selling at a higher price. You don't want to sell at a lower price. It doesn't suit you as the seller. What suits you better is selling at a higher ticket and allowing someone to buy it from you. So that's what essentially is happening. Someone's buying something from you at that price point, and you're going to sell it there to them. And they're most likely buying it what? In a premium. They brought it way more expensive than what you had brought it for. They made a profit on it. So they most likely brought it cheap, and then they sold it to somebody at a higher price. That's what's going on with the market here. So you want to see price now probably target the previous daily low if we liquidate the previous daily high while being in the premium for Sunday's opening price. If you play it forward, you can see here, price comes down, you're in short here. Where would your stop loss be? Most likely above a sessions high. I would say the New York session high, or even the high of the day, Thursday. And as you see, you play it through. Going into Friday, we take out what? That low. And this is all through NFP. Not to say every NFP is going to look the same way, look like this. We can see how quickly price comes down, tries to get through that previous daily low. From a Wednesday, sideways. It didn't really go anywhere. It was still consolidating. Came back into the range of this consolidation. Thursday now consolidates. It's holding the price before NFP. See how long it gets down to a certain period, and then it just starts consolidating. Even during London, London doesn't go anywhere far compared to Thursday. Look at Friday's London session compared to Thursday. Much smaller. And if we just had a measure in pips, 64. So let's say 64.8. Let's say that's 65 pips. And then if we had to measure the day of NFP London, it's nearly half that. Doesn't go anywhere until the event occurs. And then everything else follows. But that's how I would get into the market short, just in a real general way of just reading the price action. Now, we know we have other models like the New York model, the London model, the Asian model. But if I had to teach somebody this starting up trading, a very straightforward approach, it would be this. Wait for price to be above in a premium. That automatically tells you should be looking for sells. Do not look for buys. There are going to be some buy opportunities, But I think it's just dangerous for you as a retail trader to try and buy at a higher price. Just wait for the best opportunity to sell in the premium. It will come. Don't buy here. The only time you buy is when you get back down into a discount, which is what we showed here for GU. It's inverse of what's happening here. You can see price is buying in a discount. It's cheaper. They're buying it back up and they push it right back what? To premium or fair value, the opening price of the actual week. It got back to the open. That means something, especially towards the end of the week. There might be a change in trend. Why pull traders all the way down here and then to bring it back up above the open? Because they probably may want this to continue going higher. You can also see there's a market shift here. So you got the speed up here, here, and here. Price trades back down into that. That could be another continuation leg higher. So that's what we could probably suspect there for GU. Just my opinion on the market. But if it's going to be bullish, you're looking to buy Monday. I don't really prefer Monday, but Monday, Tuesday, Wednesday. Could happen again on Thursday. If you're still, think about where you are relative to SOP. If you're still below it, but on Thursday, you could still probably take that opportunity. Same thing for Friday. You can still take that buying opportunity. And sometimes that one opportunity that you catch on that one day can end up leading into a trend or a series of days trending higher. And I think that's what most traders would love to achieve, but it's very difficult for most people. Most people are very good of scalping 10, 15 pips, getting in, getting out the market. And if we just take a look at UJ next, and after this, we'll talk about dollar. You see that? I mentioned this in the chat too. We've been talking about the Bank of Japan recently in the chat as well. You know, interest rates, they have a negative monetary policy right now. Negative rates mean lower yields. Nobody's most likely interested in Japanese yen. I don't see why any investor would want to swap out their own current currency from their country for Japanese yen with a negative interest rate. It just wouldn't be preferred. And since they have a negative rate, we know that dollar has been outpacing it and gaining a lot of strength over the last couple months versus the yen. We see here that price hits 150, which is where the BOJ had intervened, I think last year when price got here again. They had intervened and I think they increased their bond yields or buying of bonds, and it caused the dollar to drop sharply. And same thing, I believe, happened here as well. They haven't confirmed if it was them, just reporting to you guys briefly, but if you were to look into it, they haven't confirmed if it was an intervention made by them or retail traders, which I don't think, of course, we know retail traders can't do that. It was definitely a central bank buying of bonds, probably here at 150 to protect the yen from declining even lower to combat and battle dollar. So that's why we had that huge spike down quickly in that 1 hour, wiped buyers and sellers out. And then we trade out throughout the rest of the day. So after this big move, I knew that most likely nothing was going to happen. It's a large candle. You'd rather wait for a small range day to get back into a large range cycle, especially with the NFP this week. I just knew that this week was probably most likely exhausted for UJ, and we were going to probably ride right back into the decline. So right into this void here, we'll most likely trade back into it again. It's a big footprint that the market left here. You can't miss it. So your eyes would go immediately back here and try and find a buying opportunity to probably run back into this liquidity void or fair value gap. Where are you again where the buying takes place? Discount. Cheap. So if you have an opportunity to run a low, price takes out the Asian session low, you try and buy. That's what I would do. Going to dollar. Like I said, NFP week, just to be clear, if anybody else is late joining or tuning in with us, it was NFP week. I don't recommend people trading NFP week. As simple as that. Just trade the next following week. NFP week, just going to wash out all the retail traders, put everybody on the wrong side of the month, and then trade it back towards the direction. That's how I view NFP. Some people may say, oh, that's not the technical definition or that's not the fundamental definition. I personally view it that way. And if you don't agree, it's all good. So we have Sunday's opening price. Again, price comes up, premium, selling opportunities are most likely going to form on Monday, Tuesday, Wednesday. See how quickly Monday runs up into a premium? They're most likely going to find a higher price point after Monday to sell it from. And it's probably going to come back down and take out Monday's low. So you see how this low here to high, that's a large day pretty much. And look how price trades right back into that range of that day, that daily candle. Completely fills that range back over. NFP comes out, you see dollar runs up real quick, then it drops. It drops really quickly. And what does it do? It takes out buy side liquidity. So we have equal highs. You see right here, just right above in this general area, we have equal highs. Price comes up, takes out the previous daily high, and comes back down in a premium. So if this was the previous daily high, let's see, I think it's New York. Yep. Takes out the previous daily high during the news event here, liquidates everybody that thinks dollar is going to go high. Now, of course, I'm only saying that because it's hindsight, but if you had to paint a story, this is how I would tell it. Run up, take the retail traders into the market to think that it's going to continue to rally. Instead, we dump it again in a premium. So when we see where we are to the overbought and oversold natural price indicator, because this is not an indicator that I'm putting on the chart. It's just me going to the opening price and drawing it out all the way to Friday. I don't need an indicator to tell me when prices in overbought levels or overvalued levels or oversold or undervalued levels. The actual price, it's going to tell you itself. And we can see price runs up into a premium while taking out a high, selling opportunity comes into play. Now, I wouldn't be surprised if there's some type of market shift that is occurring right there above that previous daily high for that sell going into London close continuation. So if we were to bring it back just to look at it, I was watching gold when this happened. I was showing a good friend of mine. I was telling him, I was like, hey, look, I got to show you something. And I was like, look, NFP is going to come out. We're at the farm and 8:30 came out and gold just dumped. And he was like, oh, whoa. And I was like, yeah, this thing flies. That's the previous daily high right here. You can see that. So we're not missing it. We're just going to put PH right there. That's the previous daily high. We zoom into this. Previous daily high, we're looking for a market shift. You see we have no market shift. What do we have here? We do have a fair value gap. So that's things that do, which will occur. You will get a fair value gap with no market shift, and price does respect it. There are times when that does happen. I don't want people to think that it doesn't exist and it's only one way. It does exist. It comes in different fashions. You can see how there are times where it's just a fair value gap. If you study price action long enough, you'll see it simply. Sometimes it's just a fair value gap. And then sometimes, and if you could see, if you have one here on this time frame. Yep, it's right here. That's the swing low right here. 1, 2, 3. And then you have a fair value gap right through it. If we take off this, there we go. You got a fair value gap and a swing low here. Now you can see there are multiple candles here. You got a candle down here and a candle here. No wicks, but you can see how the bodies, this body here closes here and this one opens here. But you can see from this candle's low here to this candle here, you got a little fair value gap. Price doesn't trade into it and it fails. It just continues going lower. But that was an opportunity to go what? Short. You have another opportunity like that here. Oops, we do. You gotta look at the left side of the screen. Look at that. That's what? A swing low. Same idea, swing low. And you can see how price starts to respect these things and continues to make the leg lower. Another swing low is broken. With what? A fair value gap. You even have that low. You have one, two, three, four candles down. The last up close candle too as well, just to mention it, because I don't want people. What is this? We draw it all the way out. Yeah, we didn't get it to touch, but you can see how close it got to. You had a liquidity void. From this last up close candle to this last up close candle here, you had a succession of 4 candles going down. 1, 2, 3, 4. And it left a liquidity void and a fair value gap. That's another opportunity. If you see price fill that liquidity void, there could have been a selling opportunity here. You can see we don't get it, but in retrospect, you can see like how it could have been the opportunity to find a short here and goes lower. In moments like this, when you are picking PDA, just as a tip, sometimes if you know your PDA is nearby price and you want to go short, a good way to guarantee you get into the market is just reduce the amount of pips from the entry so that you get in sooner. So like, let's say if you're going short and the price action is trying to run up into it, you just lower where you would normally get in. So that if the fair value gap was here, you would probably minus 3 pips off of that, 1 pip off of it, just to make sure that you actually get knocked in with spread. Because some people don't get their entry and it gets really close to the point of reference that they're looking for to go short. That's just an idea or ways to like not miss opportunities when you know you really got one coming. You see how price trades into that market shift? And the whole idea of it being a market shift is because, let me just take care of that. There's a fair value gap running through a swing low. That should tell you that a lower swing high is most likely going to form. What happens when a swing low is broken? A lower swing high is most likely going to form after, most likely inside the market shift. And you'll see this time and time again on any time frame. And you'll definitely see it on the higher time frames in the IPDA examples. And you see price breaks down and continues to trend lower. It makes what? The same patterns over and over again. It runs down with speed. It's respected. It goes again. It makes another area of speed. It's respected. There's a small one here. I know people are gonna probably talk about. There's a small one here as well, but this one's much larger here. Continues going lower. Eventually, let's see what happens. Because like I said, I wasn't watching this. So this is, oh yeah, this is right after NFP. Yeah, it just continues to trade out. It flushes everybody out. So everybody that started chasing price, yep, everybody's in. What are they gonna do? They think, oh, retest on the previous daily high, go higher. Doesn't do that all the time. Doesn't happen that way all the time. We're above this dotted line. That's Sunday's opening price. Look at where we're selling from, above that opening price. We're selling above that opening price. And you can see price continue to break down, filling in what eventually, where all the speed and excitement came in, right at 8:30, right here. Came right back into that zone. That happens so many times. Everybody's jumping in, trying to get in when NFP drops. Sometimes you win big, sometimes you lose really big, especially if you're risking way too much. But you can see it pulls everybody on one side, liquidates them, triggers. It triggers buy stops. It triggers buy limits. Not buy limits, but it triggers buy stops. Limits would be when price is coming down. It triggers buy stops. Everybody is probably buying here on a stop. And it's also hitting stop loss orders. Anybody that was selling, it has a trailing stop, they're probably getting knocked up, turning into buy stops. People are trying to buy it back here because price is running up, and it fades right back into the excitement here. And that occurs all throughout London close here. It's just 10 to 12. This is the next session after New York. London close, reversal. So there's certain characteristics to all the sessions. London close is 10 to 12 p.m. Price reverses everything that was done for that day. Look at how they hold price tight. Price comes down to a low point. Look how they're holding it, shoots up, comes back down quickly. That's the high. Those are the clean highs rated. And that's generally how I like to go with my weekly buys. This was NFP week. Do not trade it. That's my best advice I can give traders when it comes to this week. Trade the following week. Use these same ideas. I guarantee you'll be able to find probably 1 or 2 trade setups during the week using this idea to just help you think about what cap you should have on. Should I have my buyer's cap on or should I have my seller's cap on? I'm just going to check the chat. There's any questions? 5-5. Sounds good. Cool. All right. So we're still good. We're making good time. So the next topic is going to be IPDA. So this is something that is one of my favorite tools to use going into a new month. Now, many people have asked me questions about this saying, oh, why do you use it like this? Oh, did ICT said to use it like this? Or, oh, I've seen people do it this way. There are many ways to use it. And from my knowledge, if you watch the video, it's pretty direct in what he was saying in the video. He was saying, if you come to a new month, you're going to look back 20, 40, and 60 days. Those are going to be your look back data pools for the algorithm. It has to be coded. So it has to be using a certain set database of days or prior knowledge of data to then project new data. That's how it works. It doesn't go off of no data. It has to be using past experiences and data pools to create new data going forward. And that's what ICT was essentially trying to explain to us. Now, do I know if it's exactly like that, the way he speaks about it? I don't know. Some people may take it with a grain of salt. I've been using it and I've seen consistency with it. So I do want to show you guys how I use it. So let's say we're coming to the start of the month and we are in October. Wait for 1 day. So this is October, the first trading day. So we got Monday. And what we're going to do here at this point is we're going to count back 20 bars. So I'm using the tool here. I'm on a daily time frame. So since I'm on a daily, I'm going back 20 bars from this day here. So when I go back from this day, 20 bars, we get September 4th. Then the same thing, I'm going back another 40, which is essentially 20 days from September 4th backwards. And then we got another 20 quadrant right here. I'm going to do the same thing forward. So there's a projection because we know if it's a 20-day increment that this market is working on, that means in the next 20 days, it's going to be doing something as well. So this is our time of play, right? It's essentially the whole month, the next 20 days. We are expecting something to occur going into this month. 3 things can occur. We're either going to see a bullish month, just to keep it simple, a bullish month, a bearish month, or a month that moves sideways. Those are the 3 things that we're going to see. In the month that moves sideways, you can say it's seek and destroy. It's not going anywhere. It's just accumulating orders. It's not taking a strong stance to be bullish or bearish. It just keeps going, breaking a high, then coming down, consolidating, breaking a low, then running back up and consolidate. You will have months like that. You'll see moments in times where price just moves sideways. You can see this here. You can see towards the end of April, going into May, all this sideways price action. You get chewed up here. What I like is when the market starts to do this. This is the environment to make money. Market starts moving. That's how you make money. It needs to move. Moving sideways, it's a dead fish. There's no point in trying to play with it. Price needs to move, then you can go and try and catch it. At this point, I try to find the highest high and lowest low in each one of these 20-day quadrants. So just to make it clean, keep it simple, it's 60. You got 40. You got 20. And you got 20 days forward. I'm going to find the highest high in this 20-day quadrant here. And the highest high can be the start of the month as well. Because if I'm starting here and counting back, what's the highest high within this time bracket here? This day and moving back. So I have to include this day. It's going to be this day. What's the lowest low? The lowest low is going to be here. And I'm going to do the same thing for the next one. So the highest high in the 40-day quadrant is here. The lowest low is going to be here. Highest high for 60 is here. And this is what I do every day. Now, some people say, they probably have an indicator for it. I prefer the chart. It just makes me feel more caring about what I'm doing here and paying attention. Now, at this point, I would then gather some information. Are we bullish or bearish seasonally? So I would come over here to this website, charts.equityclock.com. I would find US dollar, futures index, seasonal. It might say FX as well. They're both the same. Or relative to the S&P 500, they're all the same chart. You see as it relative to gold and stuff like that, things like that. So October, you can see it starts off going up and then going down and potentially rallying back up. May not do that exactly, but we need to follow price action and probably get a storyline to probably play out for this. This is just a treasure map. You're going to get close to what it's going to look like. You may not even get anywhere near the vicinity as well. You could be lost on the map. Or this is going to point you in the right direction. And most times it might get you really close to the truth. And sometimes sometimes the map is just too confusing. You can't read it. And that's the way you got to move with it. I personally say, look at the price action first, then look at the seasonal chart and see what you think can actually unfold. So since we have a bearish start to the month, right? So we start the month going up, rallying up, and then going down. I'm going to start to take a stance of being bearish. I also want to compare any foreign exchange currencies that are inverse to the dollar, like euro, British pound, anything, Canadian dollar, Swiss, yen, gold, if even. If we can see an inverse correlation. So we can see, I picked UCATS for this week. You guys voted, of course. And we can see it does rally up. Canadian dollar gains strength at one point, while dollar loses strength. So I'm more confident of saying, okay, dollar may be bearish this month. Let's take that stance. So we go in thinking that. This 20-day high is significant. Even though it's not a swing high, it is still a high that's significant because it's used within the data pool. It's a 20-day look back highest high. If this high is broken, that to me is considered a buy side liquidity raid. Got a raid on buy stops. Price runs up and then probably triggers people to go long. Since this is also the open of the month, we're going to mark it off. So that's the opening price. So that same ideology we were just talking about, Sunday opening price, so SOP, or the weekly opening price, the same thing can be applied here. We got the monthly opening price. And the same thing applies. Anything above is going to be a premium, which is going to be ideal for sell setups. And anything below is going to be a discount, which is going to be ideal for buy setups. So the whole time I'm up here in a premium, I'm thinking there's got to be a sell opportunity that could come my way that could be in my favor. We also can see where we are in the last 60 days from October 2nd here. The last 60 days, we've been just rallying up. It was all one-sided liquidity, buy side, buy, 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 buy. After a long trending period, especially 3 months, there could be a quarterly shift. So every 3 months, every 6 months, every 12 months, there could be a shift in the marketplace. The same way we can see every 20 days, every 40 days, every 60 days, there can be also a change in trend as well. So the next 20 days could be the new change in trend. Or we're anticipating, like ICTs would say, a quarterly shift every 3 months. So we look back 3 months, we can probably see a liquidity pool or open float available to us to target. We have this low here. There has to be a large amount of orders sitting below these clean lows here. Back in July's lows. This could be a draw on liquidity long term. Let's say it doesn't get here. We also have other swing lows that are available to us. We have that 40-day low. We have this low here. It's not the lowest low in the last 60 days, but it is still a swing low. We have this swing low here. Any of these that are still intact and not broken is liquidity pools. We also have a swing low here right before October starts. September 29th, that's a swing low, 1, 2, 3. There's sell side liquidity below that low. So if we play it forward, you can see price comes up. And what does it do? It takes out that 20-day high. Takes out the 20-day high. We're just going to note this off here. That's sell side. So price comes up. We also run a swing high here. Comes up. And then takes out the 20-day high. We still have in mind that we're in a premium. So we're not looking to buy. I'm not going to force a buy here. I prefer the buy in a discount. Price is in a premium. There's some type of selling opportunity that's probably unfolding here. Play it forward. You can see we make a turning point. Why is this a turning point? Because this is a swing high. 1, 2, 3. This could be a top of a market. Every top or every bottom is always going to be done in a 3-bar fashion. Doesn't matter what time frame it is. Since we're on a daily, it's going to be in a 3-day fashion. You're going to see the turning point happen in 3 days. If it's on the weekly, you're going to see it happen in 3 weeks when it turns around and changes its trend. Same thing on the monthly. You're going to see it every 3 months. Think about it. Quarterly shift. Every 3 months, you're going to see the market change trends. It's going to make a swing low. Just to bring it whole, just to bring a big picture to it, put it on a monthly time frame. Anytime the market makes a swing point, it's in what? 3 bars. And since we're on the monthly, that's what? 3 months. Think about this top that was made in last year, 2022, right here, September. Look at the top, 1, 2, 3. That's a swing high before this decline down, for this downtrend. Even though in the bigger picture, we've been consolidating back and forth. We haven't really gone anywhere until now, recently. Now we're starting to move. Getting into October, getting into September, November, December, we're getting into the later months. So price is going to continue to do what? Probably finish off the year either high or low. You get the yearly opening price. We could talk about many of those concepts as well, but we're only going to be talking about IPDA here. Price makes a turning point. We ran 20-day high. I like to see moments like this. And the reason I like to see moments like this is because it's another turtle soup opportunity. We run buy side. What's available to us in the next 20 days? Is it buy side or sell side? I think sell side would be the only one available to us right now, according to the IPDA data range that we have here. That's not to say it can't use another swing high that's higher above it outside of the IPDA data range. But if I'm using the last 20 days as my data pool and those highs and lows, I'm going to be working with that primarily. Swing high forms, play it forward. You can see now we're starting to see a trend, because if it wanted to respect this fair value gap, right? So it fills up more than the mean threshold. So half of this fair value gap, showing no respects or regards to consequent encroachment and respecting it, or the mean threshold, it doesn't do anything there. Continues to trade lower. And this is where we are now currently. NFP comes out. What does it do? It whiplashes everybody, makes an outside bar, takes out the previous high and previous low. But you can see how now you have 3 days consecutively going down. We've been taking out the lows. For a while, we've been just taking out highs. But anytime there's going to be a swing point, you're going to see a high or low rated. Every swing point is rating the previous high or the previous low. This is a swing low. 1, 2, 3. Hopefully I'm not losing you here. That's a swing low. 1, 2, 3. What makes this a swing low, guys, is that the candle on the left is higher and the candle on the right is higher as well. And I'm referring to the lows, not the bodies. The low is higher on the left and the low is higher on the right. It only takes 3 bars to make a swing point. This is the swing point here because it's the lowest point between 2 candles. That's a swing point. That's sell side liquidity here. Notice how it does it in 3 bars to go up. But notice the middle candle is rating the previous daily low and the previous daily high. Notice that. It does it here. And then does what? Continues to trend up. What happened here? It took out the previous daily high and previous daily low. Is this the swing point? Is this going to be the lower swing high that's forming above in a premium? Because we know if the market's going to be bearish, dollar is going to make a swing high above the monthly opening price. Get the retail traders, get the sheep or the public on the wrong side. They think, oh, dollar's going to be super strong for the next 4 months. But in actuality, that may not happen unless it's in a super bullish cycle. Every 3 months, there might be a challenge to that trend, and we could be seeing that challenge here. Now, it doesn't have to come down to the 60-day low because people may be saying, oh, I'm projecting it all the way down to the 60-day low. That could happen, but think short term. This is a long-term play, but think short term. What's your most obvious area of draw? This swing low. We just brought price back down to what? A discount. So at this point now, any ideal selling scenarios have been lost. Look how quickly that happened. They brought price. It's only been what? A week, essentially, into October. It's only been a week. And look how quickly they sold at a better price than most people already. They sold at a premium. Now, if this month was going to trend down, let's just say theoretically it did this. We know it's not going to go straight down like that. But let's say it did that. It was already too late to get this best sell before it got down here. Selling down here feels more riskier to you, which is why you got to be vigilant at the beginning of the month. Notice where the turning point is going to occur. And we're going to talk about the turning points with the smash day candles because all of this goes hand in hand, hand in hand. And the reason I'm so adamant about this is because I'm a swing trader at heart. I like to swing trade. I like to hold trades for 20 days. I like to hold trades for 2 weeks at a time. I like to find those setups because I think it's worth my while instead of trying to hunt smaller scalps every single day. I don't want to sit in front of the chart. Me personally, I don't want to sit in front of the chart. Hurts my eyes. I got other things to do. I want to get into other business ventures. I want to start a farm. I want to do so. I don't have time to sit here. So if I can find a swing setup and hold it, and know I can hold it for the next 20 days and have a proper risk management and a proper stop, I don't have to sit in front of the screen for that many time. I don't want to be a slave to the trade. I just want to be free and do whatever else I can do. I get here once a week or twice a week, find an opportunity that I can find above in a premium or below in a discount. And that's where we are currently in price. So that's how I would use IPDA. Now, I do have a series on YouTube that shows this as well. It's called the IPDA Data Range Library. If you check it out, you'll notice a lot of the examples that I show are in similar fashion how I use IPDA. We have something like that unfolding right now. So if you check that out on the playlist on my channel, you'll see that. I'm just going to check for questions, and we're going to move on to the next topic. And we got some questions. Do I have a question about IPDA? So ICC does not use the first day of the month. It uses it in a different way. Could you please give me more clarification? Thank you, Deontay. Another question about IPDA. It's not working during the expansion phase because right now we are not targeting 20. Buy some liquidity. Is it? Oh, you're asking as a question. Is it not? Okay, I'm gonna answer your first question. So I can send you the link to the video as well of ICT showing you how to use it on the first day of the month. And there's also another version of him saying you could use it. One of his models is the market maker models. You're using IPDA on your current trading day. So like, let's say today's Friday, you're going to look back 20 days from today on Friday. So you have one that is going to move with you instead of one that's anchored. I have one that's anchored on the first. That's how I use it. Other people have one that actually moves with them as the days go on. So there's 2 ways to use it. It's not just one way. And another question about IPDA is it not working during the expansion phase? Because right now they're going to be, yeah. So yeah, correct. So there's going to be times in the market where it's going to trend. And if you're trying to use IPDA the way I'm using it, at least, you may not get the result that you're looking for. You might not get that turtle soup. So you can see here, let's say this is September 1st here. Let's say we look back 20 days. You can immediately know that this is the 20-day high. Look at how it runs it here going into September, but we don't get a fading point here. We don't get that. But if you can look at here for September, we had a decline, but instead for the September, what happened? We got a rally. So there's a good example of the seasonal tendency. See, try to show a lot of examples. Seasonal tendency here for US dollar was supposed to be going down. What happened instead for that month? It's going up. It went up. And I believe the Fed's pause rates in September. I could be incorrect, but I think they paused on doing rates in September. And it still caused dollar to rally. Yield still went up, though right now we can see that, just to show briefly how to find the rates. So you go global-rates.com. Looks like they updated the website because it's my first time seeing it look like this. And we got the Feds here. I liked it when they had the Feds instead of the American Central Bank, the Feds. The Feds here, 5.5. You compare that to other foreign currencies that are well established, like the Aussie, the pound, Canadian, European, and anything else, New Zealand, just cutting it. Anything else are currencies that I would personally not even look at because they're not probably the most transactional currency notes that are being passed around right now. In the system, we all know that the most highest fiat currency that's trading around the world is US dollars. Most people around the world have US dollars in their wallets or in their bank somewhere. They don't have, most people will not have, yen. It's like think about it now. Yen, negative interest rate. Nobody wants this. Nobody wants yen. Negative rate. And that's since 2016. And we've seen yen depreciate and we've seen dollar just crush. And we've seen other foreign currencies as well crush yen. So we saw GJ, EJ, CAD J, Swiss J, New Zealand J. We've seen those since that rate change from 2016. We've seen foreign currencies outpace yen. And you can check that on your charts when you have the chance. But time and time again, the rates are definitely controlling where investors are putting their money. It's a no-brainer. Just go where the yield is. If the yield isn't there, they don't want to put their money there. Go where the yield is. And dollar had a great yield. And we're seeing price breakdown. So if you go back down to UJ, same thing here. Looks very similar. That's the monthly opening price. Look at how we run the 20-day high. Quick reaction down. And we're probably reaching what? For this 20-day low. And isn't it a coincidence? This is why I say IPDA is multifaceted. It's a coincidence that on this day, it stopped perfectly on this 40-day high. What are the odds? Let's check the low. 147.336. And this is 147.378. So pretty close. Just a couple pips off from each other. But what are the coincidences that it hits that 40-day high and then runs back up quickly? That's very interesting to see. And you'll notice these little things in price using IPDA, the way I use it at least. And price creates a swing high right here. 1, 2, 3. It isn't confirmed yet because the low of the swing point hasn't been broken yet. But you can see how it created a high point above the monthly open, which could be the turning point to come down to take out the 20-day low. If not, we're going to probably continue to go higher, create a higher low, higher swing high. Or we run down, take out the swing low, create a lower swing high, and we continue to do this for the rest of the month of October. Or we go sideways. Like I said, there's 3 things that most traders are going to face during the month. It's only going to be either a bullish trend, a bearish trend, or accumulation. You can see how price was bearish, bullish, and then it just accumulates. So you had a mixture of the two here. You can see here price does consolidate and it slowly catches a leg up. So you're going to get some moments in time where more than one thing is happening inside a period of 20 days. There are many cycles. It's all fractal. Accumulation, manipulation, distribution, reaccumulation, distribution, and the cycle repeats over and over and over again. And that's UJ. You can see the same thing for UCAD. So this is what I recently posted. So I know I haven't posted in a while because I've been busy prepping for the farm. You can see I've posted here on October 3rd that I wanted to see CAD to drop, right? UCAD to drop, meaning Canadian dollar gain strength and dollar gain weakness. And the way I was going to do that was selling short on a Larry Williams smash day candle. And we'll get into that towards the end, which would be our second to last topic. But I wanted to sell short here on a stop order to catch everybody off guard because everybody probably thought it's going to continue to go high. It didn't occur there. So what I said was I just moved it up, right? I didn't take the short because the order wasn't hit. I move it to the next day, the next up candle, sell stop order here, still waiting for that great sell opportunity because I know the retail traders are probably getting pulled to the wrong side. We did take out that 20-day high, like I said here, and we're still trading higher. And then we can see now, currently, oops, we got that order to be filled right here. So I didn't move it to this candle here because I'm only looking at the up candles. Looking at the up candles low right there. That's the smash candle. And I'm waiting for price to trigger. It didn't trigger here on this day. The next day it does. Runs me right in on weakness. So I call a turning point when retail traders were most likely not catching this. They're probably looking for higher price action. Break retest, break retest. Premium. That's what kept me on the right side. I had a few fellow traders telling me, yeah, I'm buying, which wasn't bad. They probably were able to capture a few amount of pips, but I knew they were going to face a hard reality of a pullback in the near future if they kept buying. And if they didn't have a stop loss or a trailing stop, I knew they were going to get knocked out the market, which is why Larry Williams calls it a smash day candle. It smashes the people that were probably buying and hits their stop loss. It smashes their stop loss. All the buyers get smashed quickly right through that low. And it continues to go. We're still in a premium. So you still have what? Opportunity to still sell or find ideal sell scenarios. So at this point, what would I recommend someone to do? I would wait for an up candle. So if this market is truly going bearish, I'm not guaranteeing that it's going to go bearish for the rest of the month. But if you had to take the stance of being a seller because you're in a premium and you had this smash day candle confluence, you want to see an up close candle, counter trend, and then sell short. If you look at any downtrends, anytime you have an up candle, you're most likely going to face some selling. Let's just take a look at this example briefly of this leg down. I know it's hindsight, but hindsight creates exposure and exposure creates experience. Look at this up close candle and this downtrend. It doesn't matter where we start, just know it's a downtrend. This up close candle here, what happens after this up close candle? Selling. For how many days after it? 1, 2, 3, 4. 4 days selling. It still had a lower objective. As we said, we have hindsight. Let's say we didn't know where it was going, but we got another up close candle. What happens after this up close candle? Huge selling. There's signs that they don't want this thing going higher. The next candle comes out. It's an up close candle and it's small. What happens the next day? A large down close candle. So you got two ideologies going on here. You got the counter trend candle in a downtrend, and you have the small range and large range ideology from Larry Williams. So price is small and not enticing to the public eye. That's boring. This doesn't allow people to chase price. But when they see a candle like this, they start to chase price. Then the next day, they probably go heavy short. They may win, which is the thing, because there are times when retail traders do win. They may get it right for maybe a day or two, right? But then eventually what happens? They might get smashed out. Price changes trend. It goes against their shorts because they were chasing on this large day. So don't get caught up on them throwing you a bone which is a large day. Don't be the dog chasing the bone. That's the bone. Wait for a small day again, or wait for small up days again to sell. 2 up days here. So you have 2 opportunities to sell twice. You can sell on this day and sell on this day. Where would you put your stop loss? So if you're a swing trader, I would say look back the last 20 days and place your stop loss above that 20-day high. And then project forward the next 20 days low. And you can see a price trades up, immediately sells off, and takes out both lows. It takes out this low and that low. It doesn't just take out one previous daily low. This one candle takes out 2 lows. That has to be a sign that they want this to go lower. You see price trade trends lower again for another day. Pulls back, trends lower. Then you can see accumulation started to occur here again. The price traded back up to take out what? Probably clean highs again, or something that needs to be rebalanced. And it comes back down. And the same thing happens over and over and over again, but it's a month-to-month basis. Every 3 months, the market's going to change its trend. And right now, I think there might be a change in trend for the market. Dollar has been rallying, and that's put pressure on stocks. Stocks have been dropping. Now, if dollar is now going to make a turning point and dollar is going to drop, stocks are going to rally again. So I would be multifaceted and take a look at some stocks. So like look at Apple, look at S&P, look at Microsoft, look at the big tech sectors and see if they're showing signs of bullish stance coming back into play. That might be an indication that dollar is going to get weak because we know when the S&P or stocks go up, dollar declines. It's an inversely correlated thing between those two. And if dollar is going to go down, that means UCAD's going to go down, USwissy. So let's take a look at USwissy briefly. USwissy should be showing signs of selling off as well. If we take a look at October's opening price, so there's a second here. Look at how it declines. 2 up close candles, sells off. What did we recently do? We took out the 20-day look back high. Quick reaction. These are quick moments that I personally find to be really game changing when jumping the gun on trying to find where the market's going to trade. I like when IPDA gives me an opportunity like this. And it seems to only occur after the market has created a lot of open float below it. We have clean lows right down here, guys. Just sitting here. And sometime in the near future, we're going to get back here. Is it going to be within the next 2 months, 4 months, 5 months? I don't know, but I know it's going to get here. It's not going to get here in a straight line. It's going to get there in a certain fashion. So if dollar's going to go down, UCAD, USwissy is going to go down as well. And then if we take a look at UJ as well would go down. Look at British pound. Inverse is occurring. October, the opening price here. Price takes out what? The 20-day low, which is the start of the session here. That's the lowest low we have in the last 20 days. Look at how price comes, takes out that low, and immediately turns around. If you look at that IPDA data range library series, this is the same examples I was showing in those videos. So it is something that does occur, but will eventually give you troubles when price does start to trend. Because once it starts picking up and it starts trending for 3 months, you're not going to find those turtle soup conditions. So here we can see there's a turtle soup condition here. Price traded below a low and then started to rally back up. What is it aiming for? Buy side liquidity, most likely. You have this high here, which is a swing high. We have a swing high here. We have a swing high here. We have a swing high here. So we can see potential targets here for GU. Signs of this happening on other currencies should be a sign that dollar is getting weak and foreign currencies are getting strong. Gold here as well. Gold with a heavy decline. And I've been telling you folks for last, I think, 3 weeks now that I believe dollar was going to get strong and gold was going to really sell off. One of the two was lying. It was an SMT divergent going on with gold and dollar. They were both up above the monthly opening price last month. And I know they both can't be in a premium. One of them has to be in a premium. The other one has to be in a discount because it's code. They both cannot be going up at the same time for a long period of time. They can, but that's when you know that someone's stepping into the marketplace and is manipulating and holding the price for one of the two and accumulating the orders to then release it in one direction. We can see gold has declined. We have a huge liquidity void on our hands. So the last, let's say the last up close candle, which is here, to now the most recent up close candle. You have a void in price. We've been selling for 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 days. 9 days of selling. Now it's nice when you catch these trends too. When you're able to catch a trend like this, it's really nice. And we can see there's also this large fair value gap here. Market shift. Price trades back into that fair value gap for gold. Here on the daily. That's your swing low that it runs right through. Speed through that swing low, which is signs of institutional sponsorship or signs of a market maker coming into play or the algorithm kicking into gear and pushing price in one direction. You got that going on here. What happens in the near future? Price trades right up into it and gives you a nice short opportunity. And it sells off. And price continues to trend lower. And now we have a break in the trend. Because is this a swing low? Like I said, is the market making a turning point, a bottom? 1, 2, 3. So that means the next candle, let's say Monday, the next candle Monday may have a higher low than Friday, this Friday. So Monday, we look out for that. Let's see if Monday's low does not break Friday's low. That will be signs that the market most likely is going to now start protecting the lows and only aim for the highs. It's the same thing here that occurs here in this downtrend. So let's remove all of this. You have a swing high, 1, 2, 3. Price starts to trend lower after this top here. It's a swing high. What makes this a swing high, you may ask? There's a lower high on the left and a lower high on the right. That's the top of the market. In hindsight, you saw it drop down. And after getting this top, look at how all the highs are less likely to be rated once this thing starts going. Marking up all the highs. More highs. More highs. And then until here. I believe this high is rated 1879, 890. Yep. So this high was definitely rated here by this high Friday. And right there. Price then could have created a what? Bottom, but it didn't. It continued to sell off because of what? The market shift here. And we're probably aiming for something much lower in the price action. Weekly, look at these clean lows right here on the weekly. 1, 2, 3, 4. All these lows are clean. It's also what? A swing low. It's all fractal, guys. It's a swing low. Look at how there's a change in trend that occurs up here. Somewhere along the lines here, it's giving you signs that it's most likely going to continue to go lower. You have that large fair value gap here, something to draw for. And then you also have the swing low, south side liquidity. This could still probably reach down here. What would I prefer? I would prefer pull back, then go short. But there are going to be times where, hey, it might just give another candle straight down, another weekly candle like that. And sometimes you'll miss the opportunity to find a great short. Because normally the best shorts come from what? Breaking a high, which was here. Price breaks that high, quickly goes short on you. Let's just take a look at what happens there on that high. Let's go on the 15-minute time frame. New York session hits it. 15-minute time frame. We have a New York model that's happening here as well. So this is for people that may know. This is a New York model. So that's that high that it raids. We'll actually show it on another one because I want to be able to show the time zones. So this is gold. That was last month's Friday. Yep, right here. So we know it took out that previous daily high. Just to make sure we got that too. Copy it, put it here. So takes out that high in New York. But we know if we're going to use the New York model, what are we going to use to help find with the liquidity pools? The London lunch, which is going to be 5 a.m. to 7 a.m. Now I have a whole video on this as well, but just to go over, I know it's been a while since I made a video, so I'm just really trying to make sure I give you guys all the information that I normally use when it comes to trading. So this time period in the orange shaded box is 5 a.m. because people are going to ask. This is 5 a.m. to 7 a.m. New York Eastern Standard Time. This is right after the London session has finished, or the ICT kill zone has finished for London. We most likely are going to face consolidation outside of the kill zones. It's a very no-brainer. You put a session highlighter indicator on, and you put this time period on that session indicator, you're going to most likely find more times than not prices consolidating between 5 a.m. to 7 a.m. We're going to find the 15-minute time frame, swing highs and swing lows that we have available just prior to 7 a.m. So let's say it's now 6:45. Sorry. Yeah. It's 6:45, right? Got another 15 minutes till 7 a.m. We have this low of the actual start of the session here. Make this red. No, make it blue. I'm always putting things backwards. Buy side, sell side. Price starts. What happens? We quickly run down. Takes out that low, takes out this low, takes out that low. This one candle takes out many lows here. Now, if we go on the 5-minute, we might see even other fractals. So you see here, swing low right there, 1, 2. That's a swing low, 1, 2, 3. Takes that out. Also takes out that swing low. So you got that fractal idea. So 15-minute time frame, low has been broken. 5-minute swing low has been broken. We're below 7 a.m.'s opening price. Another ideology still blending here. That's 7 a.m.'s opening price. Anything below 7 a.m. is what? Discount. It's cheaper to buy below the session's opening price. If you have a bullish stance and you have the backing of liquidation, so the liquidation is sell side being liquidated. What's left and available to the market right now currently? Buy side. It's right there. And even if we had to look outside of this period, we have a swing high that's close to this high. Yeah, right here. These are all equal highs. So even if you didn't select this one within the time period, but you saw this one, you're still right. But this just gives you an idea and scope of what you can actually get realistically. An easy target of buy side and sell side very quickly on the market. Price runs down below 7 a.m. Discount, ideal for buying. Let's go down to the 1-minute time frame to see what happens. Fix this up. So we're in a New York session. We just ran sell side liquidity here. What can we be looking for? A fingerprint or some type of sponsorship shown by the market here. We want to see either down close candles not being respected. So some type of bullish order block. IPDA. I mean, actually being respected. So price trades up and creates a down candle and engulfs the previous candle, the price trades back down into it, it respects it. If it disrespects it, then odds are it's going to keep going down. Just to clarify what I mean by that, look at this uptrend here. Look at all the down candles in this uptrend. Anytime price trades down into it or has the opportunity to trade down into the down candle, it respects it. See how price opens here, trades down into the down candle? You can see how it respects it because it runs away the next candle. Trades another down close candle, runs away from it, comes back down into the down candle, respects it, runs away again. That's what I mean by respecting the down close candles. And the same thing can be said vice versa when bearish, respecting the up close candles. So if price is going to trade lower, it's going to trade up into a up close candle and then go short as a bearish order block theory. Play it forward. See, we have no, you see how it doesn't respect this one here? Price trades up, doesn't respect, would be a failed setup. Let's say a short term. Let's say you took an opportunity to go long here and you had a very tight stop right below the order block. It's okay. But eventually you're gonna probably catch the trend. You have to have your own model. How many trades are you gonna take per session? I recommend most people to take 3 trades per session. 1 out of the 3 may be a great winner. 1 out of the 3 might be one that mitigates your losses. 2 out of the 3 might be a winner. 3 out of 3 might be a winner. Whatever the case may be, just take your time and risk properly. And what I'm looking for here at this point is a market shift. That's what I prefer to look for. And I can see we don't have any yet. We don't have any on this time frame at all. So from my level of entry, I would have probably missed this because I'm looking for that PDA of the market shift, which is why I try to, be flexible. I tell people all the time, sometimes the very first fair value gap that forms after taking out that 15-minute liquidity pool, it may be the only one or maybe the only opportunity you may be having. You can see here, this is the first. Let me just double check. No, it's not the first. So you have one up here. The very first fair value gap. And this actually might be the market shift. Taking a closer look. Yep, it is. There it is. So we have the fair value gap that runs through a swing high. This one's not very apparent. That's that fair value gap is not really through it, but it's still right on it. Price trades down into it. Of course, we'd have a stop loss below some type of swing low or a certain pip increment, whether it's 5 pips, 10 pips. Gold is a little different. And we can see price trades higher after they're making that here. And you have more apparent fair value gaps. They buy it cheap below 7 a.m. Play it forward. And price does what? Takes out that 15-minute swing high. All because what is occurring here? They're holding the price action here. And that's how I like to utilize the lunch periods. It's just an area where I use to find liquidity pool that can help me grab 10, 15, 20 pips out of the market and sometimes be the trend to the rest of the intraday trade setup. So this buy setup could be the New York sessions distribution higher or lower, continuing a trend for the next couple of days. So it just takes one day for you to get into the trend. And you can see how we take out that high, price trades, and you can see how this almost looks like stairs. It's respecting the down candles. Anytime price prints a down candle, look at how it wants to get away from it. It doesn't stay there long enough. It wants to get away from the down close candles. That's what happens in the uptrend. And the same thing is fractal. It's happening here on the 1 minute that I just showed you guys on the daily. When you get an up close day in a downtrend, you sell. Same thing here on the 1 minute. Let's say you were scalping and you're waiting for an opportunity to go long. Just wait for a down candle, then buy. Don't buy when you see the green candles going up. It's not realistic. You want to buy when you see a black candle loading, when it's going down, because it's cheaper for you, getting in cheaper. When it's going up and it's a green candle, you're buying when price is going up? No. You want to buy when it drops down. And the easiest way to do it is wait for a candle to close down, then buy after it. It's a very simple idea or approach to getting into a trend, because people find difficulties getting into a trend. The most simplest thing, you're in an uptrend, wait for a down candle. You're in a downtrend, wait for an up candle. And that's all you would have to do. So that's how I would use the New York model. I know we were just talking about IPDA, but that's how I would use the New York model. And just going to check for questions. One chat. Everyone, thank you. No problem. You're so very welcome. And I do appreciate you guys coming out tonight. Your time is very valuable to me. Hope you and your loved ones are safe where you guys are on the world. Love to your family. Peace and blessings. And last but not least, we're going to talk about high probability scalping, which is one of my favorite ways to trade on the daily without having to be there all the time. So the way we're going to go about this is basically how I trade and how I find daily bias, because there's no way around it, in my opinion. If you don't learn this, then you don't know daily bias. You don't know how to catch trending moments in time. You need to know how the trend starts, and you need to know how the trend changes. Now, Larry Williams smashed a candle. I'm going to talk about this right now because I know there are many people that would like to utilize it. And I think it's a very simple one for people to get a huge bang for buck, especially when it starts to trend and compound for you. So if you don't have this book already, I recommend you to get it. If you don't have it, we can definitely, when I say we, I mean I could definitely get you the link. And I know for sure many people in the channel or the chat will definitely be glad to share the file with you. So that's available to you guys as well. Yeah, it was definitely paid for, of course, but if you need the file for it, let us know. So a smash day candle by Larry Williams. So we're on page 133 in the book and 132. A smash day candle, essentially, and I'll just read it real quick. I'll zoom in here. The siren song of greed is what keeps the public on the losing side of the ledger in this business. That is bad for them, but good for us. If we can figure out what it is that gets them to bite, what sucks them into the wrong decisions, one such event is what I have labeled smash day reversals. These are days in which the market has a major breakup or down, and this violent action pulls the public into a foray. There are two types of smash days. The first one is pretty obvious. A smash day buy setup consists of a day that closes lower than the previous daily low, which is what he refers to as a naked close, and then vice versa. So we can see here in this example here, this is figure 7.6. Says this is a close, this candle here. Now I know it's not a bar, but this here is showing that the close of this candle is above the previous daily high. And it's also above the last 3 daily highs as well. Now, Larry Williams doesn't specify on how many days. I think the more the better. I think there's probably a rule of thumb, maybe 3, maybe 8, maybe 6, depends on what you think is preferred. But generally, I think if it's above the last 3 previous daily highs and the price closes up there, you have an opportunity of a smash day candle, because everybody is very greedy, like he said at the beginning of the sentence. Many people are greedy, and what gets them to bite is seeing price trend higher and higher and higher, and then eventually there's a naked close. So a close that's so high above the rest of the other highs that makes everybody jump into the market quickly. So for example, let's look at this turning point here, because this is a good example of a smash day candle. So we're going to bring it back to here, right before the trend changes at the top. Now, what qualifies as a smash day candle? We just simply need a close, like he said, a close that's above the previous daily high. You can see this close is above the previous daily high and several others. What does this look like? This looks bearish. Sorry, I'm always doing that. It looks bullish. I'm always saying things backwards. It looks bullish, right? Quotation marks, bullish. Just add looks bullish. Everybody's probably expecting what? Price to potentially continue trending up. That may not be the case. That may be wrong. There might be an opportunity where the commercials then offset everybody. The market's trending up, but then they could either knock the buyers out and then continue to push price higher, or they could completely knock the buyers out and start a new trend. And this could be the start of the trending point here, especially if we've taken out buy side liquidity above some type of equal highs, double tops, or swing highs. This is a swing high here. This is a swing high here. This buy side that's been rated. After this buy side has been rated, do we have some type of attainable goal of sell side? We do. We have this right here, sell side liquidity. This looks bullish. Retail is what? Now chasing price. What would Larry Williams suggest you to do? Suggest you to place a sell stop here and go short on weakness. That's where you go short. How would it look? You would place a sell stop order here. Where would you place your stop loss? Now, your stop loss will depend on to you. Larry Williams does give a couple of models, a couple of examples of stop loss, consistent winning days. So if you read the book and go through that chapter, you'll see some of the models and some of the data he collected. I would say general rule of thumb, let's say you want to place a stop loss above the high or just above the high, just to keep it simple for this example, just say the high, because there's going to be moments in times where you put it at the high, you still might get stopped out. And what would we aim for? Previous daily lows, maybe the last down close candle before the rally up. So we could say this one, the bullish order block here, where it got engulfed by this candle here, this last down candle. You say that's the target, or we could just say simply the swing low. Then we play it forward. What happens? The next day, the candle opens, runs down, and triggers you in short. Price does pull back here, which could happen. But if we play it forward and we're still holding to our stop, you see price starts to trade lower. We caught the turning point. What is that you caught? The swing high. You caught the swing high right there. Price continues to go lower. You play it forward. And now if we add a confluence to this as well, look at the month that we're in, September. Now, everybody's going to think, wow, this is magic. And when it's just business. This is the opening price, guys. Look at where it's selling from. That's September 2023. That's the opening price for September. That's the monthly open. Where is it? It's above on a premium. Ideal buys, sells. Look at me doing that again. So funny. Ideal sells come in a premium. And look at how that confluence adds up. You got that smash day candle that we learned from Larry Williams. We just got liquidation of buy side liquidity. Sell side liquidity is below. Price trades lower. What did they do at the beginning of the month or the first week of the month? Look at it. The first week. Excuse me. The first week of the month. Look how it just goes straight up. Quickly, too. And then look, right back down. Got everybody jumping. Hooked them onto the line, baited them, and yanked them. That's what they did. And you'll see this happen a lot of the times, honestly, like pretty frequently. Like we have one that's happening right now, and you can see how it continues a trend. right there. So ultimately, you could be swing trading, holding a position for a couple days. Let's say, like I said, your model can look any way you want. You can optimize it by doing certain things. You'll look into it as you collect data for your trading model. You can say, I want to hold this trade for 2 days. I want to hold this trade for 3 days. I want to hold this trade to ×2 of whatever the smash candle pip range is. Let's say the smash candle is 100 pips. You want to gain 200 pips, whatever it is. You can plug and play how you want to do your model. I don't ever want to force somebody into one box. Just gonna drink some water here. And this is how I find my trading setups, honestly, or how I'm able to catch the turning point and catch those large dynamic moves when it's time to occur. Because I'm trying to catch it right when it's gonna turn, and then they turn on the engine and it just takes you in one direction. Now, if we look at most recent time, we're gonna see something that looks just familiar with like this. So we're just gonna show another example on UCAD, and we'll look at any other pair. We'll even look at stocks if we wanted to. We can see here, this candle does what? Closes above all these highs. And even with its close, what does it do as well? It takes out previous daily high. Price then what? Trades back down to that low and triggers you in short. That's that UCAD short that I was showing you guys in the chat and on TradingView. Right there. That the same model that I'm showing you here happened today. Sell, stop, order there. Go short there. You got it. With all the other confluences, seasonal tendencies. October, Canadian dollar supposed to gain some strength. Dollar supposed to lose strength going into October. That's what I'm showing there. You just go cool. And did I just change it? Yeah, I did. There it is. That's what a smash day candle is. That's what Larry Williams was trying to explain to you guys on that page there. So that same thing that's happening there. Right there. Sell here. It shows it right there. On page 134. Sell here. Closes above the prior's high. You're selling where? Right down there at that candle's low. Vice versa. And we'll show an example live too here today. Buy is happening where? At that candle's high. Because the close is below the previous daily low. Let's just look at a bullish example. Let's look at something else, like say gold, for example. I know we traded gold. We also did the daily updates for gold in February, and I know it was trending down. February, yeah. Yep, there it is. So it's like this February was a great month to trade gold, honestly. It was just like butter. The market structure was really nice that month. This is the trend, right? This is the hindsight. If you go on YouTube, you'll see me doing the daily. If you go to YouTube and you go into the daily updates for February, if you go back down the page, you'll see me do the daily updates and call this all the way down just off the idea of this swing high, breaking this swing low, because that's market structure. If you break a swing low and you get a lower swing high, sell. That's my idea. That's my to-go-to sell formula. Break a swing low, lower swing high forms, commercials are most likely selling. Vice versa, break a swing high, create a higher swing low, commercials are most likely buying. It's that simple. You don't have to make it that complex. It's a simple formula to know when you should be buying, when you should be selling. This here is the smash day candle. This is exactly the same thing that's being shown. This is a sell setup. I wanted to show a buy. I don't know why I'm selling a sell, but we'll show it anyways. This close, you see it happens on other pairs as well. This close does what? Takes out highs. It closes above several previous daily highs. Where are you going to go short? Here. You're trying to catch the turn because most retail traders are probably thinking it's going to keep going higher. But if you've come to the conclusion that you're overbought, you're above the monthly opening price, let's mark that off because it's the start of February. Look again. That's the opening price for February. What did we talk about at the beginning of this lesson? We talked about Sunday's opening price and where we sell above Sunday's opening price. Same thing occurs with the monthly chart. The monthly opening price, you sell above that opening price there. You're in a premium above this dashed line here because that's the open for the month, February 1st. Trade it forward. Look how quickly price trades down. Price opens, knocks you in short here. Stop loss is going to be where? At the previous daily high. Now, that doesn't, just because you see this high rated and then the low came down doesn't mean you were stopped, because we know that the candle progressed itself all the way down here first, most likely. We had to break down the day. On the 15-minute time frame. That's that high. Wait, forward. See, it broke the high first, right there. And it looks funny. Why is this the high? Because the new daily candle starts at, and this is gold. So for the gold is 6 p.m. For the currencies, it's 5 p.m. The new daily candle starts at 6 p.m. for gold. It already started. So it's still Wednesday, technically. But then after 6 p.m. during Wednesday, you're going to see Thursday's daily candle already forming. So technically here, Thursday just ran out. I know it sounds confusing, but Thursday runs Wednesday's high right there. And you're going short at this solid dash line there. That's the smash they sell right there. You're going short here on the stop at that low, that previous daily low right here. Going short there. And that's what you would hold. Just like that. It smashes, changes trend quickly. That's the whole point of it. You're trying to catch a quick, volatile move in one direction. That's what Larry Williams was showing us in that book. Long-term secrets to short-term trading. You could use this short-term. You can only be holding it just to get to the next daily low or several daily lows. Look how quick it does it. Takes out that low, no problem. Takes out the next low, takes out a swing low. Look at that. Targets what? A swing low. And then it does what? Creates the market shift like we saw before. I already went over this. We traded it live this year. And it creates the market shift right there. Trades back into the market shift. Up close candles, same idea. Counter trend candles. Up close in a downtrend, sell. Up close, sell. Up close. Can't see that one. Up close, small range body, large range body. Up close, small. Up close, small, sell. Great month, honestly. February was a great month. But look at how it showed itself as a bearish month. That's February 1st to March 1st. That's a bearish month. Look at how it unfolded. Pull traders where? Wrong side. Now let's go. Let's look at the seasonal tendencies for February for gold. See how it's up? Another example of seasonal tendencies not aligning with the chart. Your chart said down, but seasonal tendencies said up. And if you go back to watch those daily updates, you can see how I was fighting against the seasonal tendencies. I was saying I wasn't supporting the seasonal tendencies. I was seeing that the market was most likely going to break down because of the shift. That's a fingerprint that's significant to me. I want to pay attention to this. Regardless of what the seasonal tendency is telling me, oh, bullish gold. I don't have to marry that idea just because the seasonal tendencies told me so. The price action will tell you if that's going to most likely occur. It did not. It did not. And we were able to get that short there. But that's a smash day sell. Let's find a smash day buy opportunity. Let's do something like British pound, Japanese yen. Perfect example right here. Got a leg up right here. Look at this leg straight up. Now, there's many others here as well. And I'm just showing the ones that are most obvious that will make you more interested in saying, oh, wow, I see the potential of this model and how it can be a great tool to finding swing trades. This large candle comes down and does what? Liquidates all these lows. All these lows get crushed. Clean low, swing low, all that gets knocked out in one candle here, one swoop. What is happening here? Retail traders are chasing price. Why are they chasing price? Because the close is so far below previous daily lows. What are retail traders doing? They're chasing price. Why? Why are they chasing price? Because it looks bearish. That's what Larry Williams had said. I think he said, I don't know if he said looks bearish in his book, but in essence, it looks bearish. You ask people that when you ask them to break down a chart, you're like, hey, how does this look? They're gonna be like, it looks bearish. It looks bullish. Most people are generally gonna say that in a quick, simple way to tell you what they think the trend is. It looks bearish just because of this. But that's how they get people. You're chasing it. You're chasing this price action, especially since it's large too. So you have that combination confluence of the natural cycle of the market. A large candle is going to most likely draw people to the table because it's enticing. They don't want to miss out on another candle like that. So what do they do the next day? They most likely say, I'm going to go heavy short the next day. Doesn't work that way all the time. That's the most dangerous points. It could turn around. You play it forward, you see what happens. Price instantly turns around. Where are we going to buy? Here at the high. Do we get triggered in the next day? We do not, which is okay. We could still hold that order there. We could still be looking to go long there. Didn't get triggered yet. There we go. We're in long now. We're in the market long. You can see we're going up. We're closing above highs. It's taking a strong stance. It's going up. Play it forward. Down close candles. So you do get some pullback on you. And over time, what happens? Price continues to trend. And notice how this trend is going up. It's most likely going to do what again when it starts trending? Protect the highs. Doesn't want to break lows. Look at all the lows. Until it has to what? Knock both sides out. Knocks out this buy side, knocks out sell side. You got an not ICT. Larry Williams, apologize. A Larry Williams outside bar candle. And when you get a candle like that, I keep saying ICT. But Larry Williams would tell you, don't trade the next day. So don't trade the next day if you most likely get an outside candle. See, these are little filters and things people don't use or utilize in the trading. Of course, you can't use them all, but if you want to use a few that you think stand out the most and you think is most efficient, go with that. Back test that, research that. And that's a bullish smash day candle here. It's down. And you also see this is also blending of what? An ICT order block theory as well. That's where I think he might have got the idea from. He would have to speak on that. I have no idea. But in similar fashion, when I see the smash day candles, I think of them as order blocks as well. Large down candle, then the next day comes in and engulfs it, most likely. And then price may trade back down into it. And look how it shows respect to this down close candle as a bullish order block theory. Price trades down into it, runs back up. And you'll see it for any trend. Look at this. Look at this very large trend. This is why it's so powerful in my eyes. If you can catch the trend for the next 3 months, 4 months, it can be really beneficial. This is a smash day candle. Look at it. This candle closes. This is a very good example. These examples probably only come once in a while, but it's very rewarding if you catch them. Swing low is taken, right? So we have sponsorship coming in by taking sell side liquidity. It's ideal for the commercials to buy after taking a low because you're buying cheap. Everybody wants to buy lower. Retail is probably chasing this, probably thinking, it's going to go short, break retest potentially, right? Or prices probably closing below all these lows. So it has to be selling the next day, right? There's different ways the retail mind may be thinking. All we have to do is buy and wait. We're just stalking the high of the down candles, especially the ones that close below the previous daily lows. Previous daily low, bottom left. Sell side taken, sell side liquidity taken out. What do we have available to us? Buy side, right? This is how you frame a trade. Doesn't take much, especially if you're studying this and you know what you're looking for. Where are we now? We're looking for price to probably turn around and hit this high here. Let's try and see what happens. Play it forward. Oh, we're not into the market long yet. Now we're into the market long, and you can see it's doing it with speed. It's a large candle. It closes above the highs. It closes above your entry. It closes above the swing because that's the turning point. You see, this is why I call the smash candle the turning point. It's the turning point. You're catching a new trend going higher. What could you aim for? Swing high, swing high. What's above those swing highs? Buy side liquidity. When you start to look at the market this way, you're like, oh, wow, there's so many opportunities. I never saw it this way. Oh, wow, I know how to catch the trend now. I just have to be patient to catch it. You have to. You can't catch a huge move every single day. The market does not work that way. It doesn't give you large day after large day after large day after large day after large day. It goes large, large, small, 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 large. It goes back and forth. It's going to throw different combinations at you, but we could take an educated guess that all we have to do is wait for a small day. Then boom, we're going to most likely catch a large day on one of the calendar days, on one of the trading days, especially if the market's going small. Once the market goes into large, we should have already ate out of the market. We've already made our money, and we most likely hold, break even, scale out, whatever the case may be. Then you let the other guys get in late. You let the other traders get in late. Then they're all rushing to the market. Damn, I missed the move on gold. Man, I just missed the move on oil. It's too late. They're going to chase now. And they're never going to win. It's a difficult struggle that people have, retail traders have. It's a psychological warfare that goes on within themselves. They can't stop chasing price. The market, for some odd reason, when they see the large candles, they think about, wow, I could have been in that move, but I wasn't. Dang, I should be getting in now. I'm missing all the moves. So they deposit it right into their live account. They buy a new challenge account, whatever it is. They get into the market, boom, they lose their initial deposit because they wanted to chase price and think that they're going to get rich in one day. Some people make it, though. Some people hit big, and they're right. But it's not a reliable and consistent way to go about your trading career. Control your psyche. You see the large days, wait for the small days to come again. This large move up, you shouldn't be looking to trade probably the next 3 days. This large day right here, you got to wait for what? Candle to do what? Go back to small. What does it do? Go back to small. And you also could see this is a smash day candle itself. So it's so many opportunities. Look at this. This candle is what? Closing above previous daily highs. What do you have to do? Just stop the low. Go short here. You might have caught another short-term move. And it could definitely pull into this, right? The void. 1, 2, 3, 4. 4 days up. Last down close candle was here. Liquidity void. partially filled in. Range is what? Rebalanced. Let's go higher now. We accumulated in this area for a bit. Finally, time to take off right here. Buy, buy. And you see price down day. So many ideas you see in the chart. Down day, buy, small day, large day. And people wonder how you catch these large days. Now, the tip. So if you're trending in the market, right? Let's say you missed this opportunity here. You're like, oh, Deontay, but I missed a smash day. I missed a turning point. Not a problem. If you still have a reasonable idea that the market is going to draw higher from your technical analysis, your fundamentals, and your macros, and you think that the market still has room to go higher and it's close to liquidity pools that is easy to reach for, like this, and you miss this, all you got to do is wait for a down day. Where do you buy on that down day? Great question. This is where you could get in with two positions if you want to. So there's two ways to get it. You get in with a limit order or you get in with a stop order. So let's say you miss this turning point with the smash candle that we learned from Larry Williams. You don't get that long opportunity here. But you open your MT4 Tuesday night and you see, oh, it's about to close bearish. You're like, what should I do tomorrow? If I think this is going to go higher and still didn't get to my target, right? So this buy side here, and you think it's going to run up here, what do? You place a buy stop order at the daily candles open, buying on strength, and you place a buy limit order at the close of that daily candle, buying on weakness. So when the market goes down, you're triggered in on a buy limit. These are little tips and tricks that I think are really crucial to people that want to swing trade. And then you use a buy stop. It's very simple methods to get in. Stop loss is going to be where? Most likely the previous daily low. You're swing trading, you're most likely not using all of your equity. You're not allocating all of your equity. So let's say you have 50K. Let's say you only delegate 50% of that account. 50% of that 50K is what you want to trade with. And then you do the 1% of that 50%. And then you move on and you swing trade. So you don't have to admit that you're using so much capital or utilizing all your equity. You don't have to utilize all your equity. If you can psychologically tell yourself that you don't have as much money in your account, you can lower your risk. It's a long-term goal. It's a marathon. You're not trying to get rich over one night. This is not the lottery. What happens here? The next day, oh, I clicked it. There we go. Look at how you're triggered in almost perfectly, right? Here, candle opens literally at the close of that candle. Trades down a little bit, pulls people to the wrong side. You know, you got the open, high, low, and close going on. AMD probably going on. Price comes down, runs up. What does it do? It runs up with speed because it's large. Large, small, large. Right there. Now, even let's say this candle was green instead. It was still up, but it still closed here. It was up candle. It opened down here, went up and closed here. Would you be using the buy stop and buy limit idea to get into trend? No. If it was an up candle, no. You're waiting for down days. Why are you waiting for the down day? Because it's cheaper. That's all it is. It's cheaper for you to buy. Same thing, vice versa, in a downtrend. Wait for the up, then sell. Price runs up and continues to trend up. So you see that. Down day. Look at that. Same thing. Same idea. What would you do? You do the same thing. Buy stop. Buy limit. Right there. If you're in an uptrend, it should show signs of respecting this candle. It should want to run away from the down close candle because it has higher objectives. It doesn't want to be around in this vicinity. It wants to move. If it needs to come down and fill liquidity voids, it will. If it needs to come down and refill an imbalance, a volume imbalance, a gap, order block, mitigate orders, it will do it. And time again, you see the same thing occur over and over and over again. Simple patterns. Down, down, up, down, large, small, large. over and over and over again. You see how here it's a large candle and there's a small green candle. I wouldn't want to use this model here and use a buy stop and a buy limit here. Now, thinking about it, if it is a green candle, right? Now, knowing me, it is if it is a green candle, just thinking on the fly here, right? And it's trending up, and it's most likely not going to take out the low, then just buy at the high. That's one thing you can do, but I would prefer you to buy cheaper going down first and then price running through it, than to buy high first. So your buy limit would be your best bet because you're buying on weakness. You're buying when it's going down. Your buy stop is a little more riskier because you're buying at a higher price, but you're anticipating the volume from the kill zone, the volume from the overall trading day, the news event, whatever world speaker is talking, whatever central bank is about to raise rates or inflation data is going to come out, job reports is going to come out, NFP, CPI numbers, manufacturing numbers, housing numbers, all these other things can be influencing price and causing more speculation for people to come into the market, and the whales come in, move price, liquidate people. And that's how I would do it. So that's how I would utilize the Larry Williams smash day candle. And they're all over. Just take a second to look and take your time with it. For example, this is a smash day candle. Even though the low is taken here, think about it. Even though the low is here taken, even though the low is taken and the high is not returned to, this candle still closes below all the lows. So you can still be looking to buy at this candle's high, even though this candle didn't trigger you yet. Because I know that's going to be a question. There it is. You buy. Down. You're still in long. And that's all off of just buying off of this candle here. Yes, there's probably lower time frame opportunities to take less risk. But if you don't have the time to do that, or if it's something that you're still learning or trying to get used to trading intraday and training your eyes to look for certain things and patterns that you recognize, I think this one is very obvious to look for because it doesn't take much more data. This can also be a fractal idea. Doesn't mean that it doesn't occur on the weekly, that it doesn't occur on the monthly, that it doesn't occur on the yearly, 30-minute, the 1 hour, the 15. These things are all fractal. The larger time frames just make up the smaller time frames. It's definitely fractal. Cool. Can you take a look at NVIDIA? I'll take a look at NVIDIA for you. Could you also show a bullish example of a smash day candle leading us up into catching a turning point? I did. Did with UCAD. So, okay, like let's look at this right now currently. So it's going up. You see how opportunity arises here? You would have been stopped. Like I said, there's going to be moments where you're going to take losses. You're not going to be perfect every single day. But look how this is a potential new turning point. So this was a turning point here, leading into a new turning point potentially to unfold here. Also here, but it's never triggered here. You see here, price comes down next trading day. Come on, there it is. It will trigger you in there. You would have went short on that candle's low, and look how price comes back, takes out the previous daily high. So it's probably making a higher swing low. It's probably failing to break the market structure lower. It continues to go higher instead. So this trend is probably really strong. It's respecting the down closed candles. And if we keep playing it, we probably will run into a turning point eventually. Yep, right here. So here, smash day candle again. Opportunity rises. Smash day candle. Price trades back down into that candle's low for once. Right there. You can go short there. That's another opportunity that could be unfolding here. Some huge spikes here going on. March, what was happening around here? And that's how you would find another trend. So that's just going from one trend, going to another trend. These trends don't have to last forever. But when you do catch a trend that lasts for a pretty long time, I bet it feels great because you took no effort to find that setup. It doesn't take much at all. And to prove that it is fractal, just go on the weekly. You got one here. There's so many examples that you got one here. That's a smash day candle. This close is below several weekly lows, and it also takes out a swing low. What happens? The next candle, the next week trades down, doesn't get back to that candle's high. But the following week, what happens? Strong moving up. Look how small this week is. Look how large the next week is. Zoom into that. I'll highlight the smash day candle like this. That's the smash day candle. The close is below several weekly lows. Price finally gets back to that candle's high. And what does it do? It takes off from that candle. Buy at the high, runs off. Notice how it comes back down. Looks like it almost came right back down into it, which is why I say it reminds me of a ICT order block theory. Price can then turn back down into that smash day candle and then run higher. Same thing here. This is a smash day candle here. Look at that. They're very apparent. They're around. That's another example. This is the weekly chart. Look how powerful this could be. And then we're going to look at in the video because I think somebody asked. I'll do this real briefly. And then we're talking about high probability scalping. And I think that will be the final topic. So we're looking at the video. It looks like we're in a bullish trend. Because of what? This candle is doing what? Closing above several highs. So if you were going to anticipate a short to come into play, how would you go short? You would probably try to go short here, according to Larry Williams, smash day candle at that candle's low next Monday, and see if you get triggered in short, or Tuesday or Wednesday, whenever that comes in. And what would you aim for? Sell side liquidity. Have we ran buy side? Yeah, we have right here. We also ran up into a volume imbalance too here. We also had one down here, smash day candle. Our price closes below. That's the wick. Here we go. Closes below. And what does it do? It trades back to the high. Go along there. Look at how it trends right up. It's a turning point. Why is the smash candle the turning point? Because it most likely liquidated some type of liquidity pool that was substantial enough to get the market to turn around. And then you can see price turns around and is trying to aim for swing highs if this bullish trend is going to continue. So hopefully this just shows how fractal and how all these markets are similar or all the same. If you go to the S&P 500, see, I figured I marked this off a while ago when I did this. I knew most likely the S&P and stocks were going to go lower and dollar was going to go higher just off of this formula here. Swing low broken plus lower swing high equals bearish trend. We had that swing low broken here. It wasn't broken with speed, but it was broken. There's a market break occurring. No market shift. There's a market break occurring here. Then we got a lower swing high. 1, 2, 3. Price is now going to look to trade lower. We got up day, sell, up day, sell, up day, sell. What is this? This is a smash candle. Look at what happened to the S&P this week. Right? NFP came out and everything. Markets went strong. This is a smash candle, folks. What is this? A swing low that was rated. That's sell side liquidity. So you can see how these things line up together. That's sell side. Looks bearish. Close below previous daily low, or lows, multiple lows. Retail is going to do what? Chase shorts. They go short the next day, nothing happens. Market stalls on them. Doesn't even take out the previous daily high. Doesn't even take out the previous daily low. It's an inside bar candle. Price is now inside this candle. It's an inside bar. Price then has to make a decision to what? Break outside this bar, up or down. And as you can see, it decides to break up outside that bar, this bar here. So price was confined at one point inside this box. But you can see how it smashes through. Finally, price gets back to that high, and you buy there, smashes through. What is it aiming for most likely? Buy side liquidity. We also have what? A gap up here that needs to possibly be filled as well. Liquidity void, fair value gap. We have those things that still need to be rebalanced. And if this is the turning point here, wait for down days on stocks to go long. The general rule of thumb, you always want to buy stocks cheaper. If you're not doing, options and stuff, you want to buy all right stocks cheaper. You want to buy Apple at 150 and not what it's at right now. It just makes sense. You can see this is a smash candle. Its close is below all these lows. Let's mark it out. Look at that close. Looks bearish. Price finally turns around. There we go. Got it. Bullish trend. What did we do recently in time? Took out sell side. We need buy side now. That's what's available. External, internal. So you can see from this high to this low, we get outside its range. So if we had to measure it like this, right? Put a cap on top of this and a cap below this. You're inside a range. You got external, you got internal, and you got external. Right, so it's what? Gets outside that range by taking out that swing low. What does it do? Comes back into the range for what? Internal liquidity that was built into the middle of the range. Look at the range from this high to this low. What's inside this range? These equal highs. And this funky volume imbalance gap. Oh, this is messy, man. And you can see price probably trading back up, take out the clean highs, and properly come back and take out liquidity above this high up here, right? Externally. And then what would it do if it got back up here? It's probably going to make liquidity pools in the middle of this and then go back in, internal, then back out external, and then it goes back and forth. So there's a lot of ways you have to look at the market. I never say it's very easy, but I do think if with a little bit of practice and actually comprehending how the candles form without any indicators, I think things would be a lot more smoother for traders in general. Now, the high probability scalp model is pretty straightforward. I'm going to show it on, let's say, gold. Everybody likes to talk about gold, right? The high probability scalp model works in one way, and there's another way you can use it, but I'll show you the way that I prefer to use it first, and another way that you could potentially use it as well. Very quick approach to finding a opportunity. So what you would need is a swing high and swing low. So you need a swing high or a swing low to be broken. That's the very first step. So let's take a look at, and we have this example marked up already. Right here. So February, we had a swing low broken. So we'll take off all this that we don't need right now. that off. We'll take that off, and we'll take this off. So you have a swing low broken. Now, when a swing low is broken, and as this one is, there's a market shift because you see the speed through it. That to me is an indication that somebody with bigger pockets than me or is getting ready to move this market in another direction than when it was trending. So this was trending up, but then all of a sudden we finally got one huge market shift to the downside. Not a market shift to the upside and not a market break to the upside, to the downside. This is indication that somebody in the marketplace does not want the market to go up. It's a clear indication that something's wrong here and something is different from what was occurring going up. This is a sign, telltale signs that price is going to go short. So market shift occurs and a swing low is broken. So that's the first step. Now, ideally, you want to have it with a market shift, but if it's just a market break, you can still go along with the formula. So one, swing low is broken. Step two, we need to wait for a lower swing high. So let's say we're watching it live and it's playing. We're like, okay. It's still not, we still don't know if this is going to be the swing high because price could come back up. And we're still playing. Now we know it's a swing high. So we have a swing high that forms. And this swing high is lower than the most recent swing high. How do we know that? Because if you just look up above price, there's a swing high up here. Swing high. And this one's higher. A higher swing high. This one's lower. It's a lower swing high. So you already have signs of market structure giving you respects to wanting to go lower. Swing low. So step two, we need to wait for a lower swing high to form. After that lower swing high forms, we're going to be looking at that third bar or that third candle in that swing, which is here. This low is going to be important for the next daily draw. This is going to tell you whether or not you should be confident in going short after this low is broken. So if this low is broken the next day, whatever candle breaks that low, you need to try and raid that low that breaks this one. So play this forward. This candle is broken here with this candle. Now we'll zoom in. This low is broken. This is the low. That's the high probability scalp. So I'll make this one gold. You're aiming for that low as the high probability scalp. That's what you're going to try and snipe. You want this to be ran over. Quick, easy objective to grab. Because you have the idea of the lower swing high, price is protecting now the highs. It shouldn't want to run back and take a high. It already did it here. The trend has changed. So we're waiting for now the third candle to be broken. That was the third step. So third, wait for the third bar low to be broken. Once that happens, you're going to go short till now the candle is broken. Aim for candle that breaks third bars low. And that low is right here. And you would look to go short. Now, many people ask, how do I go short going into the next day, aiming for this here? You could be doing that during the Asian session. You can be doing that during the New York session. You can be doing that during the London session. Now, some people may ask, what if it gets to that low before the kill zone? That's okay. Wait for price to get back into the kill zone and look to aim for that low again. If it hasn't already been surpassed, look to aim for that low. And if you can't get that low anymore and it has been surpassed aim for another liquidity pool or a different objective on a lower time frame. You can see here, price opens, quickly runs out that low. That's a high probability scalp. I know the odds of that low being ran was high odds. Here in this example, we get an outside bar, so it runs the high, which is probably unlikely, but it will happen and occur. Here, price runs out the high, but also runs out the low. And you'll see that this is a very good way to find a confident day to say, yes, I know for sure, let's say like 85% of the time, I know for sure if it does this step and this step and this process, this low is most likely going to be high probability of being ran over, or this high is going to be most likely high probability of being ran over. That's how I like to gauge my high probability scalps. And if you had to take a look at what it looks like on the 15-minute, that's what it looks like right there. So New York gives you a short right down into it. New York, a little bit more of a whipsaw this day. I'm not sure if there was a news event or some speaker, but definitely a huge whipsaw here. Seek and destroy, takes out the London high, takes out the London low as well, takes out the Asian low as well. And then it finally gets down to that previous daily low as the high probability scalp. If you even go down to a lower time frame, oh, we can't. Not enough data for this resolution. That sucks. I don't know why TradingView would say you could replay and see everything, but they don't allow you to see all the data. But that's how I would utilize the scalp opportunity. If you have to zoom in to see what happens after it, because this could be the start of a new trend. So it's not like you have to stop there. It could continue trending lower. So you see how it takes out the low. The next day, what could you be aiming for? This low too, right? So now you probably have higher confidence that it's going to keep going lower. Let's disregard that it is an outside bar. Let's say this was an outside bar and it never took out the high. Let's say it only took out the low. Confident that the low is going to get rated. You're confident in that. And you can potentially catch a trending move continuing to go lower. Like I said, eventually there's going to be a turning point, which is why Larry Williams was trying to mention, be careful before jumping in head in over heels. Just because you see price selling off or buying really fast to the upside doesn't mean you have to jump in. Price still takes out the low. See, three lows, high probability scalped. 3 lows that were high odd scenarios that it's most likely going to get ran, and not the highs. Look at the highs, not ran, only the lows. Another one. This thing keep trending. Another one was targeted. Let's see if we get this one. And we don't. So we got to change in trend. Market is breaking the trend because instead of breaking a low, what does it do? It breaks a high. It breaks a high. And look at how it continues to sell off. So we finally throw traders off with the up closes, and then they sell it off. But within that means you're able to find some feasible lows to take out. It doesn't take much to kind and find the daily trend. It just takes a little bit of patience and waiting. Not every day is a trading day. You need the market to change the trend. It takes 3 bars. It's going to be 3 days normally that you're going to see it unfold. It's not going to unfold every single day in that swing because each part of that swing is different. Remember that. A swing high and a swing low has 3 days that have 2 different meanings. One is going to be higher than the other two, or one is going to be lower than the other two. That's how it's going to go. And that's going to look different in the price action for you as a trader. It's going to be a buy opportunity. Then there's going to be a sell opportunity. And then there's going to be a buy opportunity again in a swing low at least. Then vice versa. There's going to be a buy opportunity. Then there's going to be a sell opportunity. Then there's going to be a buy opportunity. So you got to be vigilant and stick to one thing. I know there's a lot of ways to break it down, but I believe that the fashion that I do show it can be effective to helping improving anybody's trading. I think the approach is very simple and very beginner friendly, at least for those that are still trying to figure out the market, and even for veterans as well to help redefine, like, oh man, that's how you find the trend. Ah man, that's real crucial market structure that I need to be following. The recipe doesn't change for anybody. It's the same thing over and over again. Swing lows, swing highs, swing highs, swing lows, swing lows. Repeats. And they just need to be higher, they need to be lower, and they need to be rated. That's the whole point. The lows and highs need to be rated for you to then be reactive. Don't just get in head over heels because you see the market selling really fast. That's how you're going to hurt yourself. It sells fast, then you try to sell, and then all of a sudden the market feels against you. We all have been there. There's no point to chase the price anymore, especially now that you know that the market has two psychological cycles to throw people off, large and small. And a small candle makes people uninterested, but the large candle makes people very interested. It's just night and day. So hopefully that makes sense. Could you share with us both ICT videos into? Yes, no problem. I've shared it in the channel before, and I don't have a problem sharing it again. And no problem. If you guys have any questions, please let me know now, as we are now coming into, what time is it? 10 o'clock. It's 10:23 here in New York. So if you do have any questions, please let me know. Just gonna wrap it up here. It's been a while since I posted a video or recorded a video and spoke to you guys. I just wanted to do it. Just been busy, you know. I try my best. No problem, Kim. My pleasure, guys. I'm just gonna wait a few more minutes. If anybody has any questions, just let me know. We could go through that. Do you trade? No problem, guys. Do you trade Asian model during NFP? Yes, I do. I do trade Asian model during NFP. I even showed, yeah, I showed this week, UCAD, UJ, a couple Asian session models that work during NFP. I think that's a very realistic model to use during NFP, because since the week is already seek and destroy, the model itself is pretty forgiving and giving you 10, 15, 20 pips real quickly in one direction. So yeah, hopefully that answers your question. I do trade the Asian model during NFP weeks. And there are times where NFP New York model worked out hand in hand. And that's also another good thing. These models can definitely help you trade the news. Yeah, I'm gonna just give it like one more minute. And yeah, it was a pleasure, guys. Hopefully you guys are improving your trading. I'm always trying to push the boundaries on myself as much as I can, at least, and just keep studying, you know, even if I'm not trading and I'm looking at other markets that I don't trade, you know, if I'm looking at stocks, and I don't trade stock options or anything. I mean, I do invest, but like I don't trade stock options. So I do look at it in general just to gauge the market, and also helps me be multifaceted. If I see stocks going down, dollar must go up. If dollar goes up, that means gold's going down. That means UCAD is going up. All these other correlated things. So it's very good to not be one dimensional as a trader. You got to expand your knowledge. Yeah, it definitely applies to crypto as well. All markets are the same. All markets are manipulated, no matter what people say. As much as people were saying, "Oh, crypto is decentralized," and next and the third, it's not decentralized. Everybody's saying, "Oh, it's decentralized," but it's all centralized. All the markets are centralized because they're all coded, and if you have enough of one person that owns the asset, doesn't that mean it is controlled? So it is. Do you find yourself using AMD concepts? Yeah, I do. So AMD, it's a pretty classic concept. I was showing that earlier in the video with the weekly ranges. You'll see that AMD does occur. Even with IPDA itself, too. Like IPDA is a form of AMD. It's just a larger scale of AMD. Since we know trading is fractal, you're gonna see AMD in many other places. Like I think I showed the AMD idea. Just gonna remove this on the DXY at the beginning of the year. It was towards the end of the year and then going into the beginning of the year. It goes from like January to February. Yeah. Where is it? Yeah, it was right here. So it was December. So right here, it's perfect, nice little AMD setup. So if I had to highlight December, gee, I got examples. Most people, they won't bring examples. They don't be studying and remembering certain moments in time into March, start of March right here. So you can see this is a fractal idea. December, not a good month to trade dollar, of course, or trade certain commodities or certain assets, of course. But you can see what this is price moving sideways. So you got you got the accumulation, December, choppiness. Yes, it is trending lower, but it's not a significant move. It's still seek and destroy, it's still going down, then coming back up, then coming down, going back up. Its general direction was going down. Let's see what the seasonal tendency for December is. It's down. Not surprised. It's down. And this is for 2023. You see the chart says 2022. So it's using last year's data to get the new year. So when 2023 is around next year, your seasonal charts are going to say 2020. I mean, when next year is 2024, your seasonal charts are going to say 2023. But I think they don't drop until like maybe the second week in January. This website at least gives it out. I like to use this as a resource. I know other people use other ones. But you can see this is the accumulation in December. What happens in the beginning of the year? Think about that. The beginning of the year is very exciting. No matter what anybody tells you, the beginning of the year or the first quarter is very exciting. And then the last quarter of the year is very exciting as well. So you can see price comes down, and this is your manipulation. So you got your M to manipulate everybody for that 1 month of January at the beginning of the year. And then you got that distribution come back in right there for February. Get everybody on the wrong side for 1 month, January, 2 months that you shouldn't really be looking to trade. February, you come back, you make some money right there. Flush everybody out. Get everybody thinking hard. Speculation, that's what's happening here. This is all speculation because we're moving sideways. Finally, that speculation is met with an answer. It's going to break one way. What does it do? It gets everybody long at one point right here. Takes out the swing high. People think, oh, snap, dollar's probably going to go strong. Break retest. It doesn't happen. Then they fade it. Then they get everybody short. Then what do? They buy it back. So it's confusing. They whiplash you. They pull you around. But there's small things that you can do to protect yourself. We can't trade as much as the larger big dogs, but we can definitely scale in on a lower time frame and take 10, 15, 20 pips out the market per day, or maybe once a week. Maybe you're just getting 20 pips once a week. That's not bad. And that's AMD right there on a higher time frame perspective. And we can see comes back down, fails, and breaks down, takes out the lows, takes out the clean lows. And after taking out all those clean lows, look what it does. Takes off. And it did that for 3 months. We go into July. No, we go into August, September, and basically now October. So we could say this month could be the shift for the quarter. Price is going to come down. Towards the end of July too. July was definitely trending up for a bit, but it was trending down majority of the time. July comes up, August comes up, September keeps going up, and then finally October. Is this going to be the change in trend? Potentially. Right there is smash candle. Right there. It's another smash candle because I mentioned this before. There was one here. Failed though. It would have been most likely stopped out. Close above the highs, comes down, does get you in short. Does get you in short here. You can see how quickly it runs lows. Well, just this one here, low here. Fills what? Fair value gap, very small one. So I do like the smash candles for the purpose of how quickly the market can inject you into the market at that low point or the high point, vice versa for the buy or the short. quickly into the market. Get in there with a micro lot, you get in there with a standard lot, you can do a little bit of damage. And there we go, another smash candle here now forming. Here, you go short there. And right now we didn't get a strong displacement or close below it. Hard pullback too, but this NFP, like I said, NFP week, difficult week. But NFP week most likely is going to give you insights to what most likely is going to happen for the rest of the month. That's my personal take. The first week, we got to get everybody on the wrong side. Once we do that, we got to reverse the price on them. And NFP is normally going to be the last flushing of getting people on the wrong side and knocking them out. And then the market makers take all of the rest of them, pips for themselves. And you don't get an opportunity to ride that wave down, because either you blew your account, now you got to make up funds, you wasted time, you don't have the funds, you got to gather more funds to do whatever you got to do, when you just could have just waited out of this week and waited another week. To not trade is to trade. That needs to be a part of every trader's trading model. There's going to be months that you don't trade, there's going to be days you don't trade, and there's going to be weeks you don't trade, just because of your own personal filters. I don't trade every single day. I don't trade Monday to Friday. I don't trade Sunday to Friday. I don't do that. There's no point to do that. I'm just exposing myself to more risk. I don't want to expose myself to more risk. I want to be able to expose myself as much little risk as possible. And I'm trying to take little hints and parameters to trade. For example, you don't have to trade London every single day. You can filter out London. What do I mean by that? So let's take a look at an example. Let's change it to like, so that really moves. Yeah, pound does move. Okay. If I had to avoid trading London session, how would I filter that out to avoid trading London? If the Asian session is smaller than 40 pips, I mean greater than 40 pips and smaller than 20 pips, that's generally a rule of thumb. So you see this one is 12.5, let's say 13, we round to 13. I would just avoid London. And me personally, time-wise, where I live on the globe, I'd rather be sleeping than trading London. To force miss sleep to make a trade is just ridiculous, in my opinion, at least in my circumstance. But then some people may not have that fortune, unfortunately, Some people may have to make ends meet and have to trade London. And if I had to filter it out, I would use the Asian session as their gauge to say, yo, should I trade London tomorrow based on what the Asian session did? If it's trending in one direction and it's larger than 40 pips, do not trade London. If it is smaller than 40, if it's smaller than 20 pips, do not trade London. There might be times where London still gives a great setup and still gives a great opportunity, even when it doesn't meet your filter requirements, but you just have to let those things go if you're going to stick to a model. You can't have it all, personally. If your model needs to be really distinctive, you can't be wishy-washy. Some days I do this, but then other days I do this. Which one is it? You got to make up your mind. Let's take another look at this. See, this one is 24 pips. It's just inside the increment of 20 to 40 pips. I would trade London the next day. London gives you a great AMD setup. London takes out the Asian session low and then runs right back up to the Asian session high. Accumulation, manipulation, distribution. Let's look at this day here. Look at the Asian session. Let's see how large this one is. This one is 19.5 pips. Just missed the cutoff. Now, this is where it comes to you as a personal trader. Some people would say, I would round this to 20. Some people may say that. And who am I to tell you not to do that? Test it out. But for me, if I'm cutting dry, this doesn't meet the cutoff. I can't use London. It's done. I should not be looking to trade London. Look what happens in London. Not much. London goes up, comes down, goes up, and then even for the rest of the day, it then would stop me out if I was going long. Would just totally avoid trading London. It just doesn't meet my parameters of 20 pips minimum. Can't trade it. Take a look at this one. So it's 32.1 pips. This gets my approval to trade London. Now, as you can see, not every day is going to be your classic accumulation, manipulation, distribution. They will buy it at higher prices because they can do that. They can mitigate the orders and continue to push price higher. This one doesn't meet the cutoff either. 14.8 pips. I would avoid London, wait for New York. So if I'm going to opt out of London, I only have 2 sessions to trade. New York and then London close. Look at this. Look at how London is just nothing here for this day. Let's measure. Gotta come lower. 17.3 pips. Look at London, choppy. So there has to be some type of indication to tell me, oh, if I'm trading London or if I'm not. I don't trade London personally, but this is just me giving advice to you guys that live somewhere on the globe that trades London. And if you can't trade the London because the Asian session doesn't meet the pip requirements and was not trending or was trending, just trade New York. Try and find an optimal trade entry in New York or try and find a scalp opportunity in New York. And then you call it a day. Or you just don't simply trade. Let's say you don't have the time to trade New York either. That means you're not trading for the day. And I think that kind of shocks people when they hear me say, hey, you just can't trade today because it doesn't meet your requirements and your standards. Why go out of the way and force the trade setup? Doesn't make sense. Just leave it alone. The question is, what do I do? Nothing. You do nothing. You wait for the next day and then you reassess. Questions. Please, can smash either be used on lower time frames for trading? So I might miss what you're talking about earlier. Oh, no doubt. No doubt. I recorded it. It's gonna be on YouTube, folks. Please, can the smash? Yeah, so the smash candle can be used on the lower time frames. It absolutely can be. So let's take a look. For example, let's say we're looking at the 15-minute time frame. So this could be used as a scalping model. Let's say we're on the 15-minute time frame. Look at this right here. So in IPDA, it's the same. If I could get it to do what I want. You can see how it also blends into going into London. What is this? Price closing above several highs and also taking out what? Buy side. Here and here. Just took out the Asian session high itself. 15-minute swing high, 15-minute swing high. This candle's close is above all these highs. So what does it look like? It looks bullish. So 15-minute time frame, it looks bullish. What can you do here? You could, if you're thinking that it's going to be a turning point because you just liquidated buy side. Did I just make that a whole ray? I did not mean to do that, but whatever. You can sell where at this candle's low here. Where would you place your stop loss? A very tight stop loss then at the high. So let's do it. So we go short here. What are we aiming for? If we just took out buy side, what is available to us? Sell side. So you can see here, it happens to be the Asian session low right there. You also have these clean lows here. We could aim for that. Is it reasonable? Can we make a one-to-one with the parameters that we have? Yeah, we probably can. So we have here, it's what, 4.4 pips. So let's say we wanted around that, say 5 pips, right, from entry that we wanted to take. And 5 pips from entry allows us to have a little more buffer above the high if it gets back up to the high. Cool. Then we bring it down. 8 pips, 8.7. Can we round that to probably 10, right? To make it a 2-to-1 ratio? Yeah, we could. That seems realistic. You don't think it could probably run below this low a little more? Yeah, it can. I think so. And then we play it out. What happens? Quick smash down. Everybody thought it was bullish for a second. Brings it down. And then if I blend the ideologies here for you, right? So the last one really. What's this? This is midnight opening price. This is MOP, right? Midnight opening price. So at the beginning of the video, we're talking about SOP, right? SOP, Sunday's opening price or the weekly opening price. This is midnight opening price. This is 12 a.m. New York Eastern Standard Time. Anything above this price point is going to be a premium. Anything below is going to be a discount. Look at how they're selling strong in a premium. It's all fractal. Look how quick they get it back down. Premium sells do not last long. When it's time for them to sell the market, odds are they don't want anybody else getting that ideal sell. It happens very early and it catches people off guard. Same thing vice versa. When it's time for them to buy and they want the market to go up and it's in a discount, it is going to leave quickly. It's not going to waste any time. It doesn't want to provide you with the opportunity to buy cheap. They don't want to provide you the opportunity to sell high. They don't want to. It's in and out. They're efficient. They're not waiting for you to say, oh my gosh, I think it's going to sell because it's overbought and my indicator finally said sell. No, they're not waiting for you. It's going to go. That's what happened here. It quickly turned around. So hopefully this answers your question on if you can use that same idea of a smash candle on a lower time frame. This is essentially what I'm showing you here. It's no different to what is happening here. Where is that? It's up here. Yep, right there. See? A close that is above the day's high. So instead, this is a close that's above a 15-minute highs, right? All these highs here. And also the context of breaking the Asian session high and recent 15-minute swing highs. Quick sell-off. Huge sell-off. That really wonderful trade there. And you could consider this what? The fake move above the open. That's the fake move to get the sheep on the wrong side. I don't want you guys to be sheep. I want you guys to be wolves. And you catch this instead. I don't want you to get caught off guard and think it's going to continue to rally. Now, if you do really honestly believe it's going to rally, there's many ways to get in the market. You don't have to wait for certain things. Just place a buy stop here. If you're thinking in that means of being a retail trader, you could just buy on strength, break retest. There are opportunities where that does occur. And instead, London continues to trend up. We've seen days like that. Same thing, vice versa. It just takes out the Asian session low and then it continues to make lower swing highs, lower swing lows. That can be an opportunity. You place a sell stop there at the Asian session low. But those times don't occur as often as I would want them to. Because I don't want to be caught off guard like that. And hopefully that answers your question. If anybody has anything else, please let me know. I will start the timer again. Because every time someone asks the question, I get into this and I just start explaining more things. I just really love this. So it's 10:46. If I don't get like a question like 10:48, I'm gonna just say goodnight to you guys. Post this and safe one to you and your family. Mm-mm. Yes, sir. We're back. I look forward to talking to you guys again too next week. All right, yeah. I'm gonna end it here. Good night, everybody, or good morning to wherever you are. Love.